Welcome to another video from thetraderguy.com. This is Chris the Trader Guy looking at the Forex markets going forward for the week of November 28th. I'm looking at the weekly time frame on these charts, and as you can see, this is the Euro US dollar that I'm looking at. The candle that I believe signals the greatest importance to me right now is the one that sits just above here in what we will call, for lack of a better term, 131. And this hammer for me is very supportive. But having said all of this, we can look at the pair basically for most of 2011, since the spring. You can see that there had been a little bit of a downward channel. It was pretty sloppy and pretty nasty, but when you really weigh the balance of the entirety of all of the moves, it's basically been a slow grind down. Looking at this, we can see that things have accelerated recently, and this makes sense because the Germans, for example, are starting to have to pay higher rates on their bonds. The Italians most certainly are. The Greeks are, they're just dysfunctional, and on and on. There are several problems in the EU right now. There's talk of possible EU super bonds, which the Germans don't want to have anything to do with. And on Friday, the news came out that the Greeks are trying to negotiate a 75% haircut on bonds, which would have banks writing down even larger capital losses. With all of this backdrop going on, it's no wonder that the euro is falling against the dollar. And that's the theme of the week coming up, is that the dollar, of course, is gaining against so many things. But let's take a look at some of the charts. And as I mentioned before, 131 to 130, I see as a support band that I think is going to be very important for the future direction of the euro. If we manage to break down below 130, that means something bad has happened. And quite frankly, even 131 would mean that. But I believe there's going to be about 100 pips of support in this area. If we can break down below 130, that means this pair goes much lower, and really, more than likely, we will see maybe a 125 handle before it's all said and done. The euro is an absolutely dysfunctional currency, and there are people openly questioning whether it's even going to exist in 10 years. Beyond me to say, but I do think that the market is reaching a very serious inflection point in the euro US dollar, and I think this week is going to be monumental, possibly determining the direction if we do get that flush down. If we don't, you still have to look at it as we've made this long series of lower highs, and more than likely anything that as far as a bounce that comes in this pair is going to be a selling opportunity. So as such, me personally, I'm not buying the euro for anything really at this point. Looking at the Kiwi dollar against the US dollar, you can see that it is broken down through some pretty significant support at the 75 handle, excuse me, and it does look like we are testing, we're getting ready to test this hammer here on the weekly chart. Now this hammer bottoms out at, for lack of a better term, 70. It's actually a little bit above 70, but not much. And it looks like that's where we're heading. We did close towards the bottom of the range, and it really doesn't look good. The Kiwi dollar is highly sensitive to risk appetite, as it is a commodity driven currency, so it makes sense that as risk appetite disappears from the markets that the Kiwi will get pummeled. It's fallen quite far over the last couple weeks, and you'll notice that it's even in the last 2 weeks has given up all pretense of trying to even find support. When this pair moves and there's panic in the markets, this pair just absolutely melts down. We could be looking at a situation like this, but it appears to me at least that the next, say, 387 pips or so, although they probably will come, maybe more of a grind rather than a free fall. If we break 70, this is going to get ugly very fast, and looking at the way this pair moves, we could find ourselves at the end of the week talking about how we are at the 70 handle. So very possible that we may see a little bit of a fall from this point. With that in mind, I still see bounces as selling opportunities. The highs keep getting lower. So it looks like we are accelerating downside. We could see a bounce, but there are several areas that have acted as support and resistance in the past that would be good selling opportunities as well. So nonetheless, if we do get a bounce, I'm ignoring it from the long side and simply looking for a selling opportunity. And a pair that I find quite interesting at the moment in time is the dollar yen, and as you can see, I have a big thick 80 line mark on the chart. And to me, this answers everything. Either we're on top of 80 or we're below 80. If we're below 80, we only want to short. If we're above 80, then we have to really start to ask questions about the trend, longer term trend in this pair. This previous week was pretty impressive, especially Friday, as far as the fact that suddenly we've got some bullishness in this pair. But make no mistake about it, 80 is certainly much more major in the terms of support and resistance than anywhere where we're at now. So for me personally, what I'm waiting to see is how far we will bounce. Now on the daily chart, the Friday candle is almost completely full and green. So having said all about that, having said about that, I believe personally that we will probably continue to rise as people buy the dollar. This is more of a run to the dollar as opposed to a run from the yen. And this is probably a reaction to the euro dollar, dollar Swiss, and everything else that is leaning heavily towards the dollar. I believe that a pop in this could continue, but at 80, I'm very interested in any signs of weakness to sell. Again, we could close above 80 and then I have to rethink the whole thing. But these are the types of areas I like to look for. Dead obvious areas that I know everybody else is aware of. I'm not trying to outsmart the market, I'm just trying to move with it. A pair that I don't typically trade, although I have to admit this is a very interesting setup. At 180, we have an absolutely beautiful and perfect shooting star on the weekly chart. It is at a significant large round number, and I believe that we could fall to 175, and as such, I will be watching this chart. Would make sense that the euro sells off in general, although typically this is a risk on risk off pair in the sense that the euro will rise in times of risk off because the euro is considered much safer than the kiwi. But in this particular case, we may have the actual selling off of the euro as opposed to anything else taking center stage in this pair. I will be watching regardless, and it's obvious to me at least that if we break the lows, at least in the weekly time frame, there's really nothing between the lows and 175. So we're probably looking at probably 350 pips pretty clear before we get any kind of massive support. The trend is down overall, so it goes with the trend as well. Not a pair I trade often, but it definitely is interesting to me at this moment in time. We could also possibly be looking at the formation of a bearish flag longer term, but at this point in time, that's still speculation. But without a doubt, we certainly have a very bearish looking setup in the euro kiwi at the moment. Looking at what I think could be the most interesting chart, go ahead and I'll walk through this in some detail here just so that I can give you an idea of what I see. This is the cable, the pound dollar weekly chart, and this is zoomed way out. As you can see, I have drawn on this the Fibonacci retracement tool from what was essentially the massive fall back in 2008 to the lows. From May to December, we just had this precipitous fall. Many of you may have not been trading back then, but it was quite a remarkable time during that financial crisis. We had a nice bounce, and then we formed this weekly shooting star right at the 50% retrace, which happened to be just below about 168, with 170 being the large psychological number at the top of that. Now, we had this rectangle consolidation here, and on this candle I shorted. I remember this trade very well, and I did quite well. That's basically why I remember. I took profits down here because I measured the rectangle, and the width of the rectangle here measured another I believe 1,000 pips, and I got out about 148, and that was an exact perfect match. Nice when you get trades like that. Well, I think we may be seeing something very similar to that about to happen. Um, in this case, we had a nice, easy to identify rectangle. We had very obvious support and a Fibonacci level just above it, but obviously a very simple and plain bit of technical analysis, and that's what you want. You want things that are simple. So let me go ahead and remove all of this, and let me get rid of the Fibonacci just to get that out of the way because it won't matter in this part of the analysis. And now I have support levels up. And you can see these lines are the typical 500 pip large psychological round numbers, and I have two here. And the reason I have two at 153 and 155 is I believe that this is an entire support zone. I think it's a 200 pip zone, and while that sounds like a lot on the weekly chart, it's nothing really. You can see that 153 supported candles here, 155 kept it down. It supported at 153 here, 155 kept it down. Same here, same here. Now, granted, we moved up and above it, but obviously 153 is pretty significant support. You can see that 153 held a support here recently, and then we bounced. Now, I'll go ahead and zoom in on the chart a little bit, and you can see that when I zoom in, the 200 pip area becomes a little bit more well defined. I'll go ahead and just draw it here. And again, it goes back in several different areas, such as like right here. So now at the end of this week, we have a very negative candle that finishes it almost at the bottom. So what does this mean? Well, you can see that the highs are getting lower, and we are approaching 153. Now, my initial analysis of this is, well, if we break 153, it's going to be very interesting. It's massive support, and we'll just see where it goes. But one thing you want to do is you always want to see at least where you think it could go. Well, my first thought, of course, being a break at 153, is I thought, well, maybe 150. The 150 area. Nice, large, psychologically significant round number. But to be honest with you, I don't see a lot at 150. One way or the other over the past. I see a reaction, but I don't see a massive reaction to that, which is quite unusual actually. Normally you would expect to see something like that. So zooming back out, as I was doing my analysis, I really started to look at this, and I started to see something that didn't stand out to me right away because it's very complex. But after a while, I started to see a head and shoulders pattern. For those of you who have never traded a head and shoulders or don't even know what it is, it's basically three attempts to rally. You have a shoulder, a head, and a shoulder, and you can actually have them inverted as well, upside down. And essentially what it means is we're trying to rally and then you eventually fail. There is a neckline that makes the neckline of the pattern, and in this case, I believe the neckline is that support zone. So now that you see this, it's a little bit more clear, even despite my horrible artistic skills on the computer. You can see that, at least in theory, this could be something of significance. So I take a look at the chart like this, and then I realize, okay, well, if it is a possible head and shoulders, what does it mean? Where are we going? Well, I have to look at the highs up here at 168 and a breakdown to 153, because much like the rectangle, you measure the height of the pattern. So let's say that this is our pattern. There's our neckline. You measure from the highest point to the lowest point of the pattern, and let's just say, for simplicity's sake, it's 1,000 pips. When you break down, you expect to see the move complete another 1,000 pips, much like the rectangle. Rectangle, same way. If it's 100 pips or 1,000 pips on the rectangle, you break that rectangle, it's 1,000 pips, like we saw back here. So now we have the situation where it looks like 168-ish, and these are round numbers, I haven't checked to the pip, to 153 could be the height of a possible head and shoulders. Now, The next question you have to ask yourself is, where is this going? Now, you can decide that you are going to measure the entire pattern, and you are going to consider the neckline to be the 153 level and this, and you get roughly 1500, which is 15 handles. So we break down the 153, and that puts you down right about 138. Well, 138 is interesting because it does have some significance in the past, and it's in the middle of this big cluster. However, if you shave a couple hundred pips off of it, allowing for a little bit there and a little bit there, considering this one thick neckline, considering it 155, because this is a special case, this isn't something that we have an obvious just dead one spot here for this support and resistance. So let's just say, for conservative sake, you decide that 155 to 168 is what you're going to use as a measuring stick. Well, that changes the equation slightly. And in fact, that becomes 1300 pips. And 1300 pips from here, depending on where, again, where you take it, but let's just go ahead and take it from the breakdown, because you have to keep in mind, and I'm trying not to overcomplicate this, but there is a little bit of leeway with this. And besides, here's my theory. I should go ahead and say this before I measure this out. If the move measures 900 pips, I'm not going to end up having a losing trade because I needed all 900 pips. I'm willing to settle for 850. Let's just keep it simple, you know. So having said all that, with this move, you take a couple hundred pips off of it, and now you're talking about 140. I think 140 might be a very interesting place to possibly look for some type of reaction, because again, now we're talking about basically the bottom of this area here. So while I can't say that this is going to happen, I can say that it is something worth watching. It is complex head and shoulders. If we break it down, go ahead and clear all this. If we break it down, we can have a doubling of this. So if I get a close on the daily below the 153, I'm actually going to be aiming for 140. And I find this very interesting because this could suggest that we're going to see some type of serious financial trouble in the markets, because cable is highly correlated to that. Now, again, we have to wait and see if we get that close below there, but there is nothing in this chart to suggest that I should be buying this pair. And as such, to see that happen really wouldn't surprise me. To see it retest this area here really wouldn't surprise me either, because that's not even making a new swing low in the big scheme of things. And again, the trend, you know, looking at the overall picture, I still have it as down, although we certainly have gone sideways and we certainly have tested this. But I think with the situation that we have in Europe and the UK, depending on Europe, is 30% of its export market, as well as the exposure of UK banks to EU problems, to me it looks like we can have serious potential for a meltdown in this pair. So anyways, this video has been almost 19 minutes long now, and I'll go ahead and cut it off here, but just wanted to show you some things I saw, and without a doubt, cable is one of the most interesting charts I see right now. I'll be keeping an eye on it, and if we get that daily close below 153, it becomes a longer term trade, and I'm going to be aiming for about 1300 pips. Okay, guys, got any questions? Email me at chris@thetraderguy.com. Don't forget to come to thetraderguy.com and check out the free educational material, and hope to see you on the forum that I have there as well. Thanks, guys.